If you've been wondering how a stock could increase nearly 2,000% in a matter of weeks when the company's on the brink of bankruptcy, you're not alone. Today we're going to take a look at the short squeeze play that was put on GameStop stock last month and try to shed some light on what happened and whether you should be getting in on the next round of insane market movement. Let's get into it. Hello my fellow YouTubers and welcome to Papaya Cast, the channel where you get the information you need today to prepare for that economy of tomorrow. A lot of people are wondering what the heck happened with GameStop stock last month. From the first trading day of the year to the close of the market on January 27th, the stock went from $17.25 to $347.51, a 1,915% increase. Needless to say, that's some pretty extreme market action, especially for a company on the road to closing down. GameStop has had a hard time competing with online gaming platforms that allow users to stream a lot of content for less money than purchasing the games individually, which is leading to the brick and mortar video game retailer to become a thing of the past, much like what happened with Blockbuster Video before Netflix changed the way we bring movies and shows into our homes. At this point, many of you may be asking yourselves, what the heck is Blockbuster Video? Google it. With the writing on the wall, a lot of investors started shorting the stock, assuming it would basically go to zero as it shut down. Shorting a stock means you borrow the shares of the stock, sell them on the market, and then buy them back later. If the stock goes down, you're able to buy the stock back cheaper, return it to the institution that lent you the shares, and you get to pocket the difference. Now, please note that short selling, as it's called, is very risky. Your potential losses are infinite. If a stock keeps going up in price, you keep losing money until you buy it back. Investors were shorting so much of GameStop stock, there was actually more shorted stock than there were actual shares of the stock that existed. A group of people on a Reddit group called Wall Street Bets noticed this too. I won't go into all the nitty-gritty details of how they accomplished this, but they were able to coordinate their trades in such a way to bid up the price, which put a squeeze on all those short sellers. As the price rose, some of the short sellers bought back shares, fearing the price would keep going up and they would lose even more. That buying helped fuel further increases.
Hey, these Reddit guys seem like my kind of people. I think Mr. Papaya needs to learn a thing or two and take a risk to shake things up. And I can't think of anything riskier than letting me do some of these videos. I'll show you some real analysis. Check this out. Now, this graph here looks like that GameStop stock price graph from before, right? Well, Mr. Papaya missed the obvious. If you flip it upside down and redo the analysis, look what you get. A W for water. Now, we got that part. We can look at the other side with fresh eyes. Flip it back around, and what do we have here? An M for melon. This graph has watermelon all over it, and this conservative papaya-based analysis isn't getting us anywhere. I need to take things over, but we got to get more subscribers. Once we hit 100, the real fun begins. So, hit that thumbs up button, share this video with everyone, and tell them to subscribe.
The result of all this was a dramatic rise and crash of the stock in the span of just a few weeks. This isn't the first time people have manipulated the market to influence the price of a stock, but I'm not sure if it's ever been so out in the open like this one was. Will something like this ever happen again? Probably. Here's the big question for you. Should you buy into the next short squeeze hoping to cash in big on it? First, let's acknowledge that this is no longer investing. It's gambling. And like gambling, you can lose everything. It's all about risk versus return. For a play like this, where the potential return is really high, the risk is going to be really high as well. timing something like this is impossible because you don't know when it's going to crash back down. So if you were going to get in on this kind of action, just acknowledge it for what it is, gambling, and ask yourself if it will be okay if you lose everything that you put into it. For me personally, I wouldn't touch it with a 10-foot pole. If you want to learn more about risk versus return in investing, check out our recent video on this topic. I'll put a link down in the description below. And for those of you, depending on what platform you're using to watch this episode, there could be a link showing up right about here, and that'll take you to it as well. I hope this episode has been useful to some of you. If it has, please give it a thumbs up and subscribe to this channel so that we can continue to break down things happening in finance and the economy to help inform you as you go about your financial decisions. If you didn't find this useful, go ahead and give it a thumbs down. And go ahead and let us know in the comment section below that all investing is gambling and that I should just listen to people in watermelon hats and shake up the style in my videos and my investing. Either way, I'll see you in the next video.